Would Lemonade be able to disrupt the insurance market? Lemonade is one of the most mainstream organizations to open up to the world this summer. It came out ablaze, with the stock up 139% in its first day of trading. However, has since faltered and is presently down 14% since its introduction. Speculators might be reluctant about Lemonade's claims that it can disturb the protection market. We are going to explore if these claims are justified. Lemonade's plan of action. Lemonade offers home, leaseholders, and pet protection it claims has worked for the 21st century. Customers are cited for month-to-month premium rates in as short as 90 seconds from the organization's restrictive AI chatbot Maya, and claims get paid in as little as 3 minutes from its other AI chatbot, Jim. Lemonade is able to get by with no physical branches or humans because it offers very standardized rates for all of its customers. Simplifying this process lowers overhead, allowing Lemonade to still make money even if its AI models are not yet up to par with traditional insurance underwriters. A guy being skeptical when showed notes. Picture source, Getty Images. One other unique feature of Lemonade's model is that it takes a maximum fixed fee to run its business, and any excess premiums get distributed to various charities throughout the year. These excess premiums are calculated on a per-person basis and distributed based on the charity chosen by the policyholder when they sign up. This may put a ceiling on its profit margin, but it could end up benefiting the business in the long run by increasing the value customers place in getting insured by Lemonade. Lemonade's focal points. Lower fixed costs give Lemonade a valuing edge over customary safety net providers like Geico, Allstate, and Progressive. Like fintech organizations versus heritage banks, the setup branches and human reps for these more seasoned safety net providers have progressively become cost trouble rather than an advantage. Also, with the world moving more online consistently, this headwind should just proceed. Lemonade likewise spares its clients time. Permitting somebody to get a protection quote shortly all from their telephone is a colossal offer for shoppers, particularly youthful ones. It's assessed that half of the individuals who lease are under 30, and that 37% of individuals who lease get leaseholders protection. Lemonade has had achievement focusing on this more youthful segment by attempting to land a client with tenants protection and afterward develop with them after some time. For instance, it states in its S1 that clients who joined 3 years prior now burn through 56% more on tenants protection than when they originally joined. This land and extend model is the way Lemonade would like to gradually work its way over the protection business and take pieces of the pie from the heritage players. Up until now, this technique has worked delightfully. From 2017 to 2019, the number of charges Lemonade acquired developed from $9 million to $116 million, while its gross misfortune proportion went from 161% down to 79%. That gross misfortune proportion direction is amazing and has likely notified the whole business. Is Lemonade's bit of leeway overhyped? One worry with Lemonade is that it has had the option to develop so quickly in light of the fact that it focused on youthful leaseholders, whom the conventional players infrequently follow. This might be all things considered as well. Leaseholders pay on normal just $180 per year for protection, while property holders pay around $1,200 per year. Lemonade's present system shows it might have caught a ton of the income sans work in the protection market. However, what happens when it attempts to persuade moderately aged property holders who have just been with their inheritance supplier for 10 years to switch over to an online just alternative? It might be simpler for Lemonade to catch new mortgage holders, yet those come around significantly less frequently than new tenants. Be that as it may, 2020 has seen a blast in lodging action due to the pandemic stirring up work. With over $1 trillion in advances given out in the course of the most recent 3 months, this could be a tailwind for Lemonade to discover all the more first-time purchasers. In any event temporarily, Lemonade's case is it has an information canal versus the opposition may likewise offer more publicity than substance. Guarantors have been gathering and investigating information for quite a long time, so it is hard to perceive how Lemonade has any supportable bit of leeway other than low straightforward expenses and an amicable client experience. Those can't be effectively reproduced, and they do enable Lemonade's to the image. Yet asserting that Lemonade has a canal as a result of the information it takes in is a stretch. Other computerized first contenders are developing rapidly as well. Root just had its IPO and basically has a similar offer as Lemonade, yet with vehicle protection, taking into account that Lemonade exchanges at a strong premium, with new copycats joining the conflict and very much promoted conventional contenders. Speculators should be mindful about its drawn-out possibilities as of now.